We're so glad 2021 is almost behind us. I believe that's the most challenging year global investors, especially those invested in China, have experienced in their career. So thankfully, we think that 2022 would be moderately market again, slightly better than this year, for three key considerations. First and foremost, because the policy stance in China has shifted from de-risking, deleverage in this year to be more pro-growth in 2022. That's for one. And secondly, on the liquidity front, the domestic household would continue to diversify away, given what's happening in the property market, to financial assets, especially equities. And in the meantime, we're also seeing strong loss bond inflow. We conservatively estimate over 250 to 300 billion RMB inflow into the A-share market. And last but not least, margins for midstream manufacturers and also downstream consumers will likely improve given the much narrow gap of PPI and CPI.
Stephen, what's your own sense on the growth trajectory in China? Because we do see China continuing to impose and implement executed zero COVID policy in the wake of rising cases, shutting down cities. And so what sort of an impact would that have on overall productivity?
Well, clearly, what's happening on the COVID-19 front still presents a significant risk for growth outlook next year. But having said that, our economists have a slightly higher than consensus forecast for next year, 5.6% growth for next year versus consensus of 5.1%. So obviously that's depending on significant stimulus, monetary easing. And for that, we're expecting renminbi 2 trillion stimulus, especially on the tech and the green investment front, to pick up the slack left by property investment. 1 trillion of that could be coming from the green-related re-lending to provide cheaper funding, and another 1 trillion RMB through sovereign green bond. And it's also the manufacturing sector capex has been picking up. So clearly, in terms of credit allocation, we're seeing credit being diverted from property sector, which the first 3 quarters this year has only registered about 5% growth year over year. And in the meantime, in terms of manufacturing, capex-related loan growth, it's actually close to 40% year over year for the third quarter. So clearly, there are much better credit allocation to higher productivity sectors. But having said that, clearly, property sector could still be the risk of a hard landing cannot be ruled out, although soft landing is our base case scenario. I think, in the end of the day, this is more likely to be a modeling through kinds of scenario over the course of, at least 2 years' time.